Good evening, ladies and gentlemen. We will begin with the session shortly. Moderator for this conference call. Before we begin with, I would like to exchange my warm welcome for joining us today for this quarterly earning call. On board, we have with us today Mr. Vineet Agrawal, Managing Director, and Mr. Ashish Tiwari, Group CFO. At this moment, all participants are in listen-only mode. Later, we will have a question and answer session. At that time, if any participant has any question, she can use the raise hand feature given in Zoom call and wait for her turn to ask question. Please note that this conference is being recorded. I would now request Mr. Ashish Tiwari, Group CFO, to mark on this meeting. Thank you, and over to you, sir.
Thank you, Simran, and good evening to all of you again. Welcome to our quarterly earning call. To start with, I would request Mr. Agrawal for presentation on business performance and results. Thank you, and over to you, sir.
Thank you, Ashish. We are putting up the presentation. So thank you and good evening, everyone. Thank you for joining us today on the quarterly call. We've had a decent quarter in the second quarter. We've reached an all-time high in terms of our turnover. Some impact on the bottom line, but again, it's more or less normalized as we say, as we speak right now. So most of these slides will be available online later on. but I want to highlight one or two points in the specifically related to the growth drivers. Between the last meeting and this meeting, the national logistics policy was introduced. And broadly speaking, the intent of the national logistics policy is to reduce logistics cost. And what we have sort of taken out of that is three main themes. The first one being that there is a disproportionate share of road transport. So the modal mix will help to reduce cost as well as reduce greenhouse gas emissions. The second is digitization. As more and more organizations become part of the digital network, we will also see a great deal of formalization. The third, of course, is standardization, which means that there will be more uniform assets that are there, which would possibly lead to better productivity, efficiency, and reduced losses, etc., in the system. So all of that will definitely help the growth of the logistics sector, and we are very well positioned to take advantage of all these three major themes around the national logistics policy. Notwithstanding all the infrastructure development that's happening related to the PM Gati Shakti program, be it building terminals or ports or the railway corridors, etc., are all going to help in these specific goals of a modal mix change that we are seeing. Clearly, the other things are also activated from a customer perspective, from a consumer perspective, and of course from the regulatory perspective. All of these things are really making the logistics sector very, very attractive as we speak. Our company strategy continues to remain the same of everything logistics. This has played out quite well with our customers as well, and they recognize the next slide, which is the wide range of services that we are providing today, which is unmatched in the Indian marketplace, and specifically covering a large range of verticals also with customized solutions. We have been investing very heavily into our multimodal network in anticipation of all the activities that have started to happen and will continue to happen in going forward in terms of the country developing its multimodal network and business. So we, as you know, if Ashish, stay on the slide, please, previous slide. So on the rail side, we have continued to grow the business both on the container transport as well as on the train automotive transport. Here, the number of rakes that we are moving has increased over the last year with close to 4 rakes per day is what we are now loading across the system. Our ships are the 6 ships are still are all there, and they are also operating in the east and the west coast. Container handles, you might find it to be slightly lower than last year, but this is also because in our Concall business, things were a little slower in the first half as there was some shift towards road transport. The number of yards that we manage and terminals have remained same, but we're in the process of adding a few more going forward. So the multimodal network has become quite strong, and the assets, whether owned or lease, rented, etc., in this space has also grown tremendously in the last 5 to 7 years. We've been also able to incubate several new areas like chemicals or even the SAARC business. We do move a lot of trains to Bangladesh and Nepal, for example. So we are using the verticals and the horizontals across the businesses very, very strategically. So even with SAARC, it's not just road, but it's road and rail. Even with cold chain, it is not just transportation, but also warehousing. And also with chemicals, we are using all 3 modes, road, rail, and sea for our transportation. So it's a very, very diversified operations, and the whole idea is how can we create more strategic boundaries around our businesses so that it creates a long-term stickiness for our clients. The operations has always been technology driven, and we continue to rely very strongly on that because again, the businesses today cannot be run with scale if we do not have all these factors related to operations, related to technology, very, very easily available, not just to our team members, but also to our clients. And one of the examples here, if you see the next slide, is essentially what we've created for a large heavy electrical goods company, where we've acquired a contract where we are handling from more than 25 locations on a monthly basis, 300 to 400 trucks, as well as providing both FTL and LTL solutions to them. So the problem statement was, since the volume was so large, how could you really create how could you move away from the manual order processing system? So we came out with a bot solution where the bot reads the emails that come or the WhatsApp, and it translates into the orders so that we are able to then reach up to the KPI of delivering, of actually providing a truck on time. And then subsequently the tracking starts. That's the creating more transparency and visibility, whether it is related to the on-time delivery, on-time submission of bills, PODs, etc., proof of delivery. So that is available to both the team as well as to customers on a dashboard as a control tower. There is also built-in areas where there are alerts for exceptions or any kind of in the next few months develop some amount of machine learning. There is also the element of estimating the ETA, which is the estimated time of arrival. That is on a small journey. Let's say when you've ordered something online from a QSR or a food company, Zomato, etc., can give you a good ETA because the journey time is very short. But when it's a long journey time, let's say if it's a 3-day, 4-day, 5-day, giving an ETA is quite complicated. There is a lot of variables that come in, from traffic conditions to road conditions to weather conditions to any kind of other disruptions that can happen, can delay the trucks or the movement. So we have written several algorithms around that, and we are trying to capture the variables in a better way so that we can predict the ETA as close as possible to the actual delivery time. This has also led to a great amount of improvement in terms of predictability, and we also geofence the route of the trucks so that if there's any deviation, it is very easily known. Now, a lot of these things existed in the past, and we just increased the element of interaction that we're doing with our clients and creating these digital control towers as we speak. And we've done this for several clients across the board. As I mentioned, this has been a strong quarter for us from a revenue perspective. It is the highest ever revenue that we've achieved at a quarter level. The overall growth remains very strong across the board. And of course, the liquidity position, though in the market seems to be a little bit tighter, but we are very comfortable. Our net borrowing remains zero. The net cash positive. We are net cash positive. And overall, the trends also look quite stable. I'll take now specific divisions. TCI Freight has grown in the last quarter by about 16% from the last year. On the half-yearly basis, the growth is slightly more. The margins are maintained at the same level, a little bit up and down. First half of the year, typically the margins are slightly lower, but they tend to pick up. Our LTL and FTL mix is coming back to track, though it is still not picked up, but it's coming back to the same levels as it was previously. And we do expect the performance to remain stable. We are at this 23-24% ROCE, which we expect to continue. As we've moved above the 20% mark, it is the business remains quite robust, even after the festive season, with high volumes and stable freight rates. On the supply chain side, this is the highest ever quarter that we've achieved in terms of revenues, and the business has grown by 27% quarter over the previous year, and about much higher than was estimated because of a very strong push towards automobile transportation. And we've seen the auto sector really come back. The two-wheeler segment has not really come back to that extent, but the other segments, from earth-moving equipment, four-wheelers to even tractors, have started to show a positive uptrend. The EBIT margins are better than last year, and of course up by 37%. EBITDA is slightly lower, but this is just a pickup time that we are seeing, and we will catch up in the next 2 quarters in terms of the margins. The overall ROCE is about 20%, and from last year we'll definitely see a much better growth in this coming year. In terms of the Seaways business, so the Seaways business had some issues related to the dry docks. So the dry docks took a little longer, and since 3 ships went on for dry docking, we saw that some amount of costs have increased here, including the depreciation, which has also gone up. Apart from that, the ships were not available for operations in this period, which also affected the top line as well as the bottom line, since some of the bottom line is also fixed in nature. So that had an impact on the overall margins of the division. Again, as we said in the past, that what we were getting in the few months before was a little unusual. We think we are now sliding back to the normal. Now that normal could be between 35% to 40%, between 30 and 40%, I think, in terms of EBITDA margins. And the second half of the year, since all the ships will be available, we think it should be much better. International operations are not there yet to that extent as it was last year. The movement from Myanmar has reduced to some extent. Fuel prices have come off a little bit, but it still remains quite high over the last year. It's still almost 60% up above the previous year, same quarter. In essence, the business remains still very strong, and we are quite confident of definitely looking at last year's numbers in terms of at least revenue, and maybe a little bit shaving might happen on the bottom line, but overall it still looks very positive. The joint ventures have had a mixed bag. The Concall joint venture has had only a marginal growth of 1.7%, and the cold chain business has grown about 13.5% in the half yearly. It is some amount is seasonal, and some of the new businesses that are coming in cold chain will get added on in the next few months. So it is we are quite positive that we are going to grow much. We will exceed last year's numbers for sure, and perhaps 20 to 30% top line on the cold chain in terms of growth. and about a 5-10% growth on the Concall joint venture. The Transsystem joint venture has done exceptionally well with a 76% growth, and profitability is also quite robust here. This is in line with the automobile growth that is happening across. In terms of the financial highlights, from a revenue perspective, as I said, it was one of the best quarters that we've had so far. Half yearly also, the business has grown by about 21% at this console level, and even the profit after tax has also grown by 22%. So overall, in some areas, the margins have come off a bit on the standalone side, with the PAT coming down by about 15% from last year. But as I said, some of it is based on the Seaways margin, which were unusually high in the last year as well. All our ratios are in order. Again, the ROCE is about 20%. We will maintain that. The RONW, etc., is also about 20%. Again, this is something that we should be able to maintain. We have given a dividend of 125% in this half year, and the cash reserves, as I was mentioning, remain net. We are still net positive in terms of cash minus very small amount of debt overall. The ratings remain the same. In terms of future outlook, we have the capex plan remains as is. However, the ship acquisition, which is the big item, is though container rates have come down by 30-40% globally, ship prices have not come down by that much. So we are still waiting and watching. We are hopeful that Q4 we are able to get a ship, but if that doesn't happen, it will get pushed to the next year. The other aspects of the construction, etc., hub centers, all that will pick up in this quarter and the next quarter. So on a reasonable basis, without the ships, I think we should possibly hit 125 to 150 crores of capex. If the ship gets added, then the capex will certainly go up. We are retaining a guidance of 10 to 15% on the top line and bottom line. Q3 and Q4 of last year were quite strong, so we will be with a higher base. But to be slightly on the conservative side, we want to maintain at this level. Thank you so much for joining us today, and happy to take any questions.
Thank you, sir, for the valuable insights. Ladies and gentlemen, we will now begin with the question and answer round. If you have any question, please use the raise hand feature in the Zoom call. I would request you to start with your name and organization name, followed by your question. So the first question is from Alok Deora, sir. Sir, please go ahead.
Alok, we can't hear you. Oh, he just dropped out. So we take the next question.
Simran, take the next question, please.
Next question is from Kripa Shankar. Sir, please go ahead.
Good evening. Am I audible?
Yes, Mr. Kripa Shankar.
Yeah. Good evening, Vineet and Ashiji. Thank you for the opportunity. One question from my side. First on the guidance. The 10 to 15% looks really conservative. If I look at, the last year, second half, if I assume a flattish number as well, that is the only way you will achieve a 10% growth. But then again, we've typically seen that second half is much better for the logistics sector vis-a-vis the first half. Any reason why you don't want to up your guidance on revenue as well as profitability?
Well, revenue, I think we can look at a 15+% also. But on the profitability, I think that 10% to 15% seems more reasonable with the Seaways margins coming off a bit. But yes, your point is right. We can definitely look at a higher revenue growth for the next 2 quarters.
Sure. Thanks. So one more question on the shipping side. While I do understand that addition of new ship is delayed due to multiple aspects, macro-led predominantly. What I wanted to also grasp is that, what would be the typical gestation period for addition of new ship? Because Vineet, you've really highlighted earlier that the new ship will be much larger in size vis-a-vis our existing fleet. And with respect to that, even if you add, let's take a ship in fourth quarter or towards first quarter of next financial year, what could be a typical time range wherein we could see that ship will run at an optimal capacity? Because I'm just trying to factor in, the extent of margin impact. If I were to see in the second half of this year, if you're not going to getting more and more Myanmar routes, then of course naturally we are going to see that profitability coming back to your usual levels, and there can be a further impact on Seaways margins if a newer ship also comes in and it's underutilized. Just wanted to get your viewpoint over there.
One is that the ship capacity that we are looking at, the largest tonnage that we have today is I think about 26,000 tons, right, Ashish?
Yes.
So we are looking at about 35,000 tonnage ship, which is not extremely large compared to what we have today. But I think what we have to observe is that there is definitely some amount of shortage on the sectors that we operate. Also, what will happen next year is that some more ships will go for dry dock. Maybe 1 or 2 ships I think 1 ship is planned for dry dock next year. Once that happens, there would be some capacity that will come out for some time. So this will cover it. We've seen that typically within a month or 2 is when we are able to really utilize it to full capacity. I mean, we already have enough cargo that we are currently telling our customers that we cannot carry. We have more than enough cargo available. So I don't think it will be so difficult to really get cargo later on as well.
Got it. That's quite encouraging. And last from my side, regarding the automotive train services, the trades which are operating for the supply chain segment, which is for finished goods predominantly to the end market. It looks like a very strong proposition. I think, you have been adding trains and they have been running at quite a good optimal capacity utilization, if I were to put it. Is there, any further addition likely with respect to it? And do you see perhaps other sectors using more and more on the domestic front with respect to, especially using trains on especially after DFC comes through? Is there some indicative things you have seen in the industry?
So what I can say seeing this with the auto sector, it started happening in just before COVID, and it accelerated during COVID. And now we can see a lot of the finished good movement is through trains. This will continue, whether it is this sector or some other sectors. In fact, now in the past we were not moving tractors, but we're moving tractors also by rail. We are moving earth-moving equipment, the big backhoes and all those other things by rail as well. So slowly and steadily we are seeing a lot of this shifting towards rail It will mean that we will continue to invest into basically a hub and spoke system for the finished goods, where we move the bulk movement happens by rail, and then the spoke movement happens by road. Or in some cases, the dealers themselves pick up the vehicles wherever they are. So that has helped us, and I think we'll continue to invest into it. Now, we might add a few more automotive rakes in the next year or two. There is some design change that is happening at the DRDO, and once that is in place, we might look at new trains. These design changes help in getting the higher, the SUV kind of vehicles easily onto the trains. Right now, it's a little challenging to get them because the height is quite high of these cars. And we are seeing that the market is also moving towards from the smaller type of vehicles to more of the larger type of vehicles. So yes, I think this business will continue to grow for us.
Thank you for the answers. I'll get back in the queue.
Thank you.
Thank you, sir. The next question is from Preet Nagarset. Sir, please go ahead.
Good evening, guys. One question I wanted to ask you, Vineet, is that we recently saw a warning given by Blue Dart on the next 6 months in terms of the business environment. They may be more on the B2C side and on the e-com delivery side. But how are you seeing the overall industry from that point of view?
We are not seeing any specific kind of issues in terms of the B2B side of businesses. We are not seeing that any inflation impact is very high yet on certain sectors and affecting those sectors. Yes, FMCG, etc., you've heard that the volume growth is not too high. That's true. On the consumer durables, we've seen a decent amount of movement during the festival season as well as ongoing. And automobiles is quite robust. So I think the next 2-3 quarters seems to be quite okay. There could be some impact in maybe Q1 or Q2 next year, but it's not yet completely visible. Clearly, inflation does have an impact. We have to see how and where that impact will flow into which sectors first. Typically, low-hanging, low-value items we're not seeing. We have had an impact like the two-wheeler sector or the FMCG sector in the rural areas. But let's see how things progress in the next few quarters.
Okay. The other question I wanted to understand is whether the national logistics policy, along with the Gati Shakti part, right now these policies give any kind of incentive for companies to follow a multimodal route?
No, there's no incentive given. There's no fiscal incentives given.
So it's more directional and infrastructural and enabling the systems kind of a policy, and hoping that companies start utilizing more of these multimodal options because of the linkages that are coming, the ULIP or so on and so forth. But there's nothing on the fiscal side to drive companies to adopt multimodal.
That's right. So there's no fiscal incentive, but as there could be some infrastructure development incentives that might come in. That's more specific to the infrastructure sector per se, not to the not directly to companies. So overall, not really any direct fiscal benefits, but you're right that it is more directional in nature. But I think some things like ULIP, which is a Unified Logistics Interface Platform, are areas where we will definitely see. I'm not saying it's a direct incentive; it's an indirect incentive, in the sense that it is prompting companies to use that more and more, and the government provides those interfaces, the APIs, etc., and that will help us. So
right.
A lot of the development around the ULIP is being done by the government.
Okay. Lastly, Vineet, are you looking to do any kind of acquisition on the rail side, given that the thrust of the government is quite visible on the rail side, and so many policies are structured around that? Do you see any specific area on that ground that you would want to acquire capabilities on?
No, not really. We keep identifying areas of such areas where there could be potential acquisition targets, but we've not found anything specifically. Yeah.
Okay, great. Thank you then.
Thanks.
Thank you, sir. I will request all to please start with your name and organization name. The next question is from Ravi Naredi. Sir, please go ahead.
To give me this opportunity, my name is Ravi Naredi from Naredi Investment Bhilwara. Sir, I am very long shareholder of the company of TCI and TCI Express. Sir, how much aggressive capex you do? Please update in how many years you do aggressive capex, which you had tell in your financial PowerPoint program.
In the last few years, we've done about 600 crores of capex, and the plan for this year is about 300 crores. Out of which some of it will go into buying a ship, some containers, trucks, and some strategic warehousing assets. Those are underway. As I said, if you're not able to acquire the ship, we should reach between 125 to 150 crores in terms of capex. And most of this will be self-funded unless there are some areas like buying ships, etc., where we will definitely think about taking certain amount of trucks and ships, where we'll certainly think about taking some. Otherwise, it is quite self-funded.
And on page number 24, you had given a financial year 23 budget, hub center and small warehouse 700, and financial year 23 6-month actual 93. What is this figure, sir?
This is in millions, so 70 crores and 9.3 crores.
9.3 crore. And ship, you have written 900 and 0.
Yes, we've not acquired a ship yet.
It's a 90. Yeah.
Okay. And sir, last is TCI Express gave 5-year period margin expansion. Can we in similar way give some view for next 5 year? I'm not asking you next 6 months or 1 year or 2 years. Can you give some vision?
No, we cannot. I think from a forward-looking statement, we would like to stick to this financial year, which is a 10 to 15% on the bottom line.
But sir, already you are 25% higher than last year. Last year 6 months. And
yes,
still you are telling.
The next 2 quarters are quite strong for us. Were very strong last year, so there could be some moderation in terms of profitability.
Okay, thank you.
Thank you, sir. The next question is from Sunil Kothari. Sir, please go ahead.
Hi, thanks for the opportunity, sir. So just one thing I would like to clarify is out of 6, 3 ships were in dry docking, and so I think you must have expanded on those dry docking. Can you provide those numbers if possible?
The numbers, the dry docking costs are typically capitalized. Right. And some amount of costs are, so most of the costs related to all the costs related to dry docking is always capitalized. So it reflects on the depreciation numbers, but not directly on the expenses numbers always.
Okay. And Mr. Second, you said that the margin which has come down, EBIT margin of CVDs in Q2 is roughly 26%, half yearly is 29%. So what we should consider as a normalized margin when all the 6 ships are in operation?
As I said, between the 30 and 40% EBITDA margin is more on the stable side. If you saw FY21, we were 31% EBITDA margin. This is before the increase in shipping rates, etc. So I think this 30 to 40% type of EBITDA should be the more reasonable number.
Sorry, last question is on that little bit medium-term volume positioning in terms of, say, growth, if it is there. What type of volume growth we will be able to handle if given business?
In which business?
Maybe over for next 2-3 years across TCI.
Yeah.
What type of volume growth is possible, which we can handle if there is a demand?
Well, handling growth is not a problem at all. I think what happens is the business works on a variable model where we can easily add on capacity, since we don't need to create capacity in some of our businesses like our like our supply chain or our freight business. In the seaways business, for volume growth, you definitely need to add more ships. And that, as I said, is part of the plan. But in the other businesses, it's not very difficult to handle the volume growth.
Okay. Thanks a lot. Thank you for the response.
Thank you.
Thank you, sir. The next question is from Alok Deora. Sir, please go ahead.
Good evening. Am I audible?
Yes.
Yes.
Yeah. Sorry for the network issue earlier. Sir, just wanted to understand on the ship purchase, because we have been talking about it since some time. So any discussions we have had, and how confident are we? Because if the ship does not come through in this year, then the growth in 24 could be slightly different on the top line as well as on the bottom line side, considering it's the highest margin segment for us. So just your thoughts on that.
Yeah, I mean, the growth is, yes, it has some impact on it, but I would say that we are very strongly looking at the opportunity of acquiring. Clearly, it doesn't make sense to acquire it at a price which is just not going to, you acquire it, but you're not going to get any returns out of it. What's the point? So it's better that you get it at the right price and at the right timing. So trust us that we are really, really working very hard to find the right ship. It's been quite tough. The market has just become it still remains quite tight as it has been for the last 1 year. Now, whether it will affect growth, maybe a very little impact in the future. Mostly, I think we'll be able to capitalize on some of the less dry docks that would be there, plus a certain amount of continuous running of these ships, and also continuously looking at more value-added cargo. But other than that, the other businesses will definitely pick up. As you've seen our supply chain business pick up, which was not happening in the previous year or in the previous quarters. That is exactly the kind of hedge we want to create in our businesses, where if there is an issue with one, we are able to utilize the other division, is able to then capitalize on the opportunity. So then you essentially get a steady state growth versus a very up and down kind of growth trajectory for many of our competitors. So I'm quite confident that the other businesses will also play their role in the next few quarters to keep up the growth momentum.
Sure. And also, sir, just wanted to understand in terms of like in ships, what would be the capacity utilization for us? We understand that the revenues were increasing because of the freight rates as well. But so at the peak capacity, how much revenue we can clock in with the 6 ships, assuming the current freight rates?
I don't have an exact number, because see, what happens is that if you get some voyages to Myanmar or to any of the neighboring countries also, that changes some of the revenue mix, right? So overall, I think we are looking to hit the same numbers as last year, and maybe slightly more than last year comparatively.
Sure. Just one last question. So, how's the freight rates been? And also, the Myanmar thing is now kind of done with, or it just paused for 1 quarter? How's just some light on that, sir?
No, it's not done with. It is still on and off. I think sometimes you see things tend to open up, sometimes they don't. So it can come back again. Also, typically the monsoon season, which is now is all getting over, is when things slow down also. So now I think the Q3, Q4 we see some pickup and maybe some voyages to Myanmar.
And on the freight rates, sir, how has the freight rates been off late in the seaway segment?
It's come off clearly. Some of it has come down because of the overall sectorally, globally, when things start to come down. It has some impact, little bit, not too much, but fuel prices came down a little bit. So that has had some impact in the domestic rates coming down a little bit.
Sure. Thank you, sir. I'll come back in the queue if I have more questions. Thank you.
Thank you.
Thank you, sir. The next question is from Preet Nagar Seth. Sir, please go ahead.
Sorry, just one last thing. Vineet, we've seen a significant change in the promoter holding. I think there has been quite a bit of stock. I think that you guys may have picked up, you and your family. Is this an internal transfer, or is it like because I'm not seeing any notification in terms of who sold?
No, this is internal gift that came. Ashish, what is the exact terminology we can?
Basically, this is an internal transfer policy, which is from a promoter or the relative.
From the promoter family, it came as a gift to the promoter promoters directly. So they were not classified under promoters, and that was a gift that came.
Gotcha. Okay, thank you.
Thank you, sir. The next question is from Vikas Khatri. Sir, please go ahead.
Good evening. This is Vikas from Abital Consulting. Sir, on the cold chain side, last year we had an investment from Global Partner. So what's the capacity expansion plan? Because that market is again growing very rapidly, especially in terms of fleet as well as warehousing front.
The market is quite strong for us. There we have some good contracts. We have some contracts with QSR companies. We have contracts with some now new companies as well. So it's quite robust. We'll see some changes up and down based on what happens with certain contracts. Some of the dark store type of contracts have its own challenges because, as I said, many guys don't really are changing their business model quite frequently. So I think going forward, we are still very confident that we continue to grow, and we should be definitely not grow at the same pace as we grew last year, but definitely we'll see a positive growth trend.
And then capex in cold chain?
It's ongoing. There's a certain amount of capex that happens with terms of new trucks and new facilities that will keep coming up based on contracts.
Okay, thank you.
Thank you, sir. The next question is from Aegis Lakhani. Sir, please go ahead. I guess he has left the session. We will take the next question from Nidhi Babria. Ma'am, please go ahead.
Yeah, hi. Thank you for taking my question. Can you quantify what was the dry docking expense for the quarter? Like, what would be the impact if you can quantify it?
Ashish, will we be able to quantify?
Dry dock. Basically, dry dock is kind of a capital expenditure, and it has been amortized over 30 months. So exactly, I do not have a number right now, but it's within the quarter, it's around uh, up to 2 crore, 1.5 crore to 2 crore kind of numbers. If you talk about the quarter only.
Okay, so if it's been capitalized and taken in depreciation, my quarter-on-quarter depreciation has been increased by only 1 crore, from 29 crore to roughly 30 crore. So, can we consider that part of it has come in on depreciation side and part of it has come in other expense side?
So
Is it
last year we had a kind of some reassessment of the life of ship as well. So it was not in the quarter two the last year, but it happened in quarter three, half of the quarter three and quarter four. So that way, if you compare, I think the numbers would be okay.
okay? Okay, and our total operating margins on a consolidated basis also margins have dropped down on a YY and Q1Q basis. So, would you like to give any guidance how it will look for the next 2 quarters?
Yeah, so if you can see the numbers, so on the EBITDA side, you would see that numbers are still 40% last year as well as this year as well. It is only kind of EBIT margins, which is because of the depreciation it has impacted. As we talked about the normalization of margin, the EBITDA level itself would be hovering from 30 to 40%, and so is the EBIT margins as well. And some impact of the dry dock, which the new dry dock would also be there.
Okay. Okay, thank you, sir.
Thank you.
Thank you, ma'am. The next question is from Aegis Lakhani. This is the last question.
Yeah, hi Vineet. This is Aegis here from Unifi Capital. Couple of questions. One is you recorded very good growth in freight. So could you just call out how much was volume led and how much was price led from the 16%?
Again, we don't quantify those numbers because for us it's mostly value growth only. What happens in our business is that if you're carrying more LTL cargo, it's you're really not carrying by the weight, so it has an impact on the volume that you're carrying. So and you know typically the value addition that we provide, as I showed with one of the examples, is much higher. So we don't really call out the volume.
Okay. And any change in that FTL LTL mix between 2/3, 1/3? Any skew was higher towards?
No, you know, unfortunately, we've not been able to grow it as, but we've got it back to the same levels as last year. But it is in the quarter Q3 and Q4, we should definitely see some pickup. But I think we are quite confident of reaching target in 25.
Got it. And the third one is, I mean, it's a more fundamental question on seaways. So when the ship goes for dry docking, do you know the exact tenure for which that ship will be in dry dock, or is it that, you know, once it goes, you know, it could get delayed by a few months here, there, or just want more color on that dry docking period?
So we get an estimate from the shipyards, etc., based on the survey that we do of the ships, and they give us an estimate. And that estimate, based on once they start opening the ship, you know, as once you open the hull or you check the hull and all those things, when you start doing all of that, then you see what could be the additional work or if there's less work required. Typically, it's you know whatever estimate we get is typically 10 to 20% more time that it takes, but it's not that it takes months and months extra. So if it's like if they give us a tentative period of say 50 days or 60 days, then it could be another 10-15 days more.
Got it. And all the 6 ships require dry docking once in what time period?
I think it's 30 months, right, Ashish?
Yeah. So basically, it is a 5-year time. So within 5 years, you have to have one major dry dock, some kind of a higher grade, and in 25 months, it should be kind of a moderate grade dry dock. So that way.
Okay, got it. And currently, I mean, I remember this year 3 ships have gone. Last year, if I recollect, 2 ships had gone. So is it fair to assume that for the full year next year, most of the ships should rather be available for, for revenues, or there is a plan that one more or two more ships may come?
I think there could be one ship that might be
One ship,
yeah.
One ship. Okay. Got it. And sorry, I think I missed could you call out how are freight rates right now? I don't think I could capture that bit.
On where? On the shipping side?
Yes, on the shipping side.
Yeah, it's come off a bit but fuel prices have come off also. So that's why it's slightly lower. And there's also typically monsoon time also things tend to be a little lower.
Got it. And no incremental competition is coming up in shipping, right?
No, nothing specific that we've heard yet.
Got it. Thanks a ton. All the best.
Thank you.
Thank you, sir. There are no further questions. Now I hand over the floor to Mr. Ashish Tiwari for closing comments.
Thank you, Simran, for moderating this call, and my sincere thanks to all of you for participating in this call out of a busy schedule. See you in the next call. Thank you so much.
Thank you.